In this video, we break down why Tesla's upcoming autonomous cybercab could completely reshape the company's business model and unlock a new revenue stream bigger than car sales. From recurring robotaxi income to AI-powered margins, we explore how this fleet could turn every vehicle into a cash-generating asset along with trajectories for Tesla stock. Let's dive in. Whether you're a long-term investor, trader, or just curious about Elon Musk's next big move, this is one you don't want to miss. Tesla stock just broke out of its month-long consolidation range and on the verge of reclaiming the 200-day moving average and pushing through multiple resistance levels. This move, confirmed by volume and momentum, comes as it tests the key 0.236 Fibonacci retracement from the all-time high down to this year's 215.87 low. Tesla, TSLA, is approaching a critical inflection point on the daily chart that traders and investors alike should not ignore. After months of compression and accumulation within a broad rectangle formation, Tesla is now threatening to break above the neckline of a potential double bottom pattern, with the 291 level acting as the key resistance threshold. As of this Tesla technical analysis video, the stock is now trading around 288, having cleared both the 283 and 285.50 volume shelf resistance. As long as price holds above 282.99, the 9-day moving average, and preferably 284.28, former rejection zone, the breakout remains valid. This area also aligns with the top of the recent wedge and should act as first-layer support on any pullback. The next upside target is 297 to 298, which aligns with a cluster of pivot resistances and the top of a recent high-volume node. If bulls can push through that zone, the next Fibonacci target comes in near 320 to 322, just shy of the 38.2% retracement level on the long-term weekly chart. That would be the stretch target if momentum continues. If you're already in, like we are, then nice work. Consider taking partial profits at 297. A breakout above that could set the stage for 320. Pullbacks to 284.28 or even 282.50 remain viable for now, with invalidation below 277.14. The structure of the current chart is textbook. The two lows in March and April form a clear double bottom at the 215 to 220 level, followed by a series of higher lows, consistent volume support, and a series of failed breakdown attempts. Price has since rallied into the neckline zone between 288 and 291, right at the 0.236 Fibonacci retracement level from the 489 peak down to 215. A daily close above 291 would not only confirm the breakout from this basing pattern, but also clear a major technical hurdle that has capped Tesla for the past several weeks. Why does it matter? The measured move for a confirmed double bottom breakout projects a potential upside target near 367, aligning closely with the 0.382 retracement zone. This aligns with both volume profile thin zones and the upper Bollinger Band expansion path. If buyers step in and sustain price above the neckline, there's limited resistance until the 320s and then 345 to 367. Additionally, the RSI is rising with room to run, and price is trending above all major moving averages, signaling strong bullish momentum underneath. While investors fixate on Tesla's margins, deliveries, and Model 3 pricing, there's a looming catalyst that's largely being underappreciated by the market: the cybercab. Elon Musk's vision of a robotaxi network is no longer science fiction. It's a developing business unit with the potential to transform Tesla's entire revenue model and send cash flows into another dimension. Tesla's Cybercab initiative is essentially the company's full self-driving (FSD) program monetized at scale. Instead of relying solely on individual car buyers to purchase FSD packages, Tesla intends to deploy its own autonomous fleet of ride-hailing vehicles, fully electric, low maintenance, and constantly active. This network would allow Tesla to directly compete with Uber and Lyft, but with far lower labor costs and 24/7 uptime. The business implications are massive. Even with conservative estimates, a single cybercab operating full-time could generate $30,000 to $50,000 annually in revenue, with margins far above traditional ride-hailing services. Multiply that by tens or eventually hundreds of thousands of Tesla-owned vehicles, and you're looking at a high-margin, recurring revenue stream that could rival or surpass Tesla's current vehicle sales. Elon has hinted that Tesla could take a 70 to 80% cut of gross fares. If successful, that turns every vehicle into a cash-generating node in a decentralized transportation grid. In terms of capital efficiency, this model flips the auto business on its head. Instead of selling a car once, Tesla would own the asset and earn income from it for years, essentially turning into an energy and transportation utility provider. FSD software becomes the margin engine. And because Tesla makes its own hardware and software stack, it can scale this system faster and cheaper than any competitor. Technically speaking, this unlocks a new S-curve of growth that isn't currently priced into the stock. It also helps Tesla expand internationally without relying on dealerships or gig workers. And if Tesla introduces a subscription tier or dynamic pricing, there's room for revenue per user to trend even higher over time. The Cybercab also boosts Tesla's AI narrative. Unlike chatbots or data centers, this is physical world artificial intelligence applied to real commerce. Every ride helps Tesla collect data, train models, and refine autonomy. That feedback loop makes Tesla's AI moat wider with each mile. Bottom line, the Cybercab isn't just another product, it's a business model revolution. If successful, it transforms Tesla from a car company into a cash flow machine built on autonomy, software, and fleet economics. The upside isn't just measured in rides, it's measured in billions. Volume is beginning to pick up, and the 20-day EMA is sloping upward. The last time Tesla had this type of setup, with moving average alignment, a Fibonacci confluence, and Bollinger Band squeeze, it ran nearly 30% in 2 weeks. If price rejects 291 again, that would delay the breakout. But given the base building and coil tension, any further consolidation is likely to be shallow and short-lived. Risk shifts dramatically higher for short sellers if bulls gain closing control above the 291 neckline. Bottom line, a daily close above 291 activates a classic double-bottom measured move breakout with 320 to 367 as the logical upside magnet. It's a breakout setup with strong structural backing, growing momentum, and clear invalidation levels. Momentum is strong, and with volume kicking in and implied volatility rising on the 300 calls, this may not be over. Stay tactical and trail stops accordingly as price advances into supply. Want real-time trade alerts and exclusive market analysis? Join our private options trading group. Link in the description. Get the exact levels we're watching before the moves happen. Let's grow together.